Retail clicks. Institutions allocate. The system reprices. You think buying Bitcoin is a button. For institutions, it's a process. And the process matters more than the price. Before a pension fund can buy a single dollar of Bitcoin, it has to answer 4 questions retail never has to ask. Are we allowed? Who approves it? Who holds it? And what happens if it goes wrong? That's not drama. That's the architecture of institutional finance. In this video, I'm going to show you how institutions actually buy Bitcoin, why it takes so long, why ETFs changed everything, and why even a small allocation can move markets in a way retail completely underestimates. By the end, you'll understand why institutional adoption is slow, and why that slowness is exactly what makes it powerful. Institutions don't ask, should we buy Bitcoin first? They ask, are we even allowed to? Wall number 1, the mandate, permission. A mandate is the fund's constitution. If Bitcoin isn't inside the allowable bucket, the discussion ends. Changing that can require legal review, board approval, and months of process. Wall number 2, the risk committee, accountability. Their job isn't to find upside, it's to prevent career-ending mistakes. They're thinking in terms of drawdowns, custody, auditability, counterparty risk, and headline risk. Wall number 3, operations, execution. Even with approval, they need plumbing, compliant brokers, reporting, custody, audits, and policies. Traditional firms weren't built for bearer assets. Retail can buy, institutions have to justify. And these 3 walls create a massive gap between wanting exposure and actually being able to take it, which is why the market had to invent new tools to bridge the gap. Markets solve the institutional problem the way they always do. They built wrappers. The spot Bitcoin ETF is the most important wrapper because it turns Bitcoin, an operational headache, into a normal security with a ticker symbol. And most mandates already allow ETFs. So the institution isn't buying Bitcoin, it's buying a regulated product inside its existing workflow. And the ETF provider handles the messy part: sourcing, custody, security practices, reporting, and the operational burden committees care about. For institutions, the ETF isn't hype, it's compliance fit. For institutions that want direct exposure, qualified custodians exist to satisfy audit, segregation, policy controls, and governance. So a fund can hold Bitcoin on its balance sheet while outsourcing the security headache. Together, ETFs and custodians are the foundational plumbing that lets conservative pools of capital cross over from traditional finance into digital assets without rewriting their entire rulebook. If you want the full framework behind videos like this, how liquidity moves, how Fed plumbing works, and how institutions actually allocate, I put Module 1 of my Macro Investing Masterclass in the description for free. It's the system I use to connect the dots. Subscribe first, then check it out when you're ready. So we've covered the barriers and the bridges. What does it look like in real life? It starts with a spark. An analyst writes an internal paper. Bitcoin is becoming digital gold. And even a small allocation could improve diversification in a world of currency debasement. It lands on the desk of the CIO. It goes on the agenda. And then the process begins. Now comes the gauntlet. The risk committee doesn't cheer. They interrogate. How do we model volatility? Who custodies it? What's the insurance? What's the counterparty risk? What happens in an 80% drawdown? What happens if the regulatory regime changes? This isn't one meeting, it's months of diligence. And after all of that, what usually wins isn't a bold bet. It's a small, defensible allocation, 1%. Because 1% is psychologically powerful inside a committee, it's big enough to matter and small enough to survive an 80% drawdown without threatening the portfolio's mission. And here's what retail underestimates. When the portfolio is enormous, 1% isn't small. It can be billions. That's how institutional adoption works. Not with hype, through portfolio math. Then comes execution. They don't market buy billions on an exchange. That would destroy them in slippage. They build the positions slowly, over weeks or months, through ETF liquidity, OTC desks, and careful sizing to avoid moving the market. And once it's in the portfolio, the machine turns on, rebalancing. If Bitcoin runs and the position grows beyond target, they trim. If it falls below target, they add. It's disciplined, rules-based behavior that creates a stabilizing force over time. The way institutions buy Bitcoin shows two markets are emerging. Retail buys on impulse. Institutions allocate with structure. Retail speculates on price. Institutions solve for portfolio role. And that changes what Bitcoin is in the market. Institutional money doesn't chase stories. It follows frameworks. Then it rebalances like a machine. And when Bitcoin starts living in the same portfolio bucket as gold, that's when everything else has to reprice. If you want to stay ahead of this structural shift, make sure you're subscribed. And tell me in the comments, what part of the institutional process surprised you most? In the next video, we're going to talk about what happens when Bitcoin starts trading like gold, and why that forces a repricing of everything.